Hello everybody and welcome. We're just about ready to start. Let's do a quick sound check, make sure that everybody can hear me all right. So if you can please type yes in the question box, that'd be great. All right, fantastic. So hi everybody and welcome to Advanced Technical Analysis for Eurodollar and Currency Market. So this is brought to you by Nadex and presented by Trade with Precision. So my name is Tamara Mer and I'm a trader at the Trade with Precision team. All right, before we head on into the presentation, let's go through some risk warning and disclaimers. So please have a read through it, make sure that you agree with it before continuing on to the presentation. So I'm going to give you a couple of seconds to read through them. And the second one. All right, let me tell you a little bit about Nadex. Well, Nadex is a derivative exchange that is subject to regulatory oversight by the CFTC. It started in 2004 and is operating in this structure since 2009. It is based in Chicago, which is the heart of the future and option financial market. All contracts are settled in cash. There is no physical delivery and offer a wide range of global markets to trade with two very unique vehicles, binary options and spread. A bit about Trade with Precision. Well, he was founded by our head trader Nick McDonald in 2006 to provide education for retail traders. We also provide international trader training for clients of global brands around the world, for including exchange and brokers worldwide. We team up with Nadex in 2011, and we are a company that runs by traders for traders, and we specialize in trading strategies that are applicable to any market and any time frame. Now, a little bit more for Nadex. You can now trade on the go, so you can download the app for Nadex and filter trading opportunities by searching binary prices from 0 to 1 and gain a fast, secure and flexible access to binary options and for spreads. Most popular markets are available in real time, and you can customize your chart with the indicators and the multiple time frame, and you can view your open position, working orders and account balance. All right, so let's see what we have on the agenda for tonight. So first of all, we're going to have a quick introduction to currency market, understand a little bit more about it, bring the newbies up to speed. Then we're going to see why the euro dollar. This is the world's largest currency by trade, so really one of the more volatile, usually not lately, but usually one of the one that is traded the most. It gives good moves and there's a lot of opportunities on this market. What is the benefit of trading currency market with Nadex contracts? And we're going to look at advanced technical analysis. So we're going to run through a couple of technical trading reasons that what we do, we look for to build up into a trading opportunity. So what we do at Trade with Precision, we're looking for reason to enter into the market for technical reasons. Now, what we say is that one reason is never enough, because what we've got is just one reason, and that tilts a little bit the odds in my favor. But what if I look at multiple reasons? The more reasons that I have, the more I tilt the odds in my favor. So that's what we're looking to do with technical analysis. So what I'm going to show you is a couple of these technical analysis tools. We're going to look at trend and multiple time frames, support and resistance level, pivot point and Fibonacci levels. Then what we're going to do is look at a couple of examples. So we're going to combine these ingredients together into a simple trading strategy, and then I'm going to tell you how you can take your trading further with Nadex. So what else can we learn on these Nadex courses, and what other levels or what other technical ingredients can we offer you to learn more about these technical ingredients? All right, so let us continue. So first of all, let's do a quick introduction to the currency market. So when we talk about the currency market, when we think about what exactly is it, there's a lot of names to it. You know, you'll hear Forex, FX, Forex exchange, currency trading. It really is the exchange between two countries' currency, the relationship between those two currency, and there's a lot of things that move that market. There is you know, if you want to go overseas, then you need to get your US dollars and you need to exchange it for someone for other country currency for that. And there is a rate that is established. Now, how is that rate being established? There is no central hub for currency. So if you think about shares, if you think about an index market, there is a central hub, there is an exchange, and everything happens in their control under their house. But with currency, it's not the same. There is no central hub. So we're looking at decentralized network of liquidity providers. So we think, if you think about that, that will be a large international bank, that will be financial corporation, and even us as individuals. Obviously, with our trading account, we cannot move the market. But the idea is that everybody who participates in the market is actually being part of that liquidity in that market. So there is no physical location. There is no exchange facility. And this is, by the way, when I'm asked about, do you look at volume? That's the reason why volume cannot be really tracked in currency as it is when you think about shares as an example, because you cannot track everything that is trading on that. There is no central hub. You cannot really calculate the volume of certain currency over the other. So we're talking about liquidity rather than and not using the volume in our chart. So what are the major currencies? Where we're looking at the loonie, so the Canadian dollar, the US dollar, the pound, the UK sterling, the euro, which is for the European zone, the Swiss franc, the Japanese yen, New Zealand dollar, and the Australian dollars. And we're looking at relationship between those currencies. So these are really the major currency. You will find other, but there will be less liquid and there will be more, less trades in them as well, less availability, wider spread, and so forth in the market. When you talk about the currency market in itself, the sheer size of it is much bigger than any other market that you would think of. So putting the commodities and the index market together, the currency market on average day moves about you've got about 4 trillion, and now there is saying that it's actually closer to the 5 trillion on volume every day. So it's a huge huge amount of money that exchange hands on the currency market. So a couple of the facts on this currency market and why is it so appealing for traders all over the world. So first of all, we've got price transparency. It really is hard to manipulate this market. Again, there is no central hub. There is no one controller for that market or for a certain pair, and it's also, it can really manipulate such a really big market. Even if you come as a liquidity provider with huge amount of backing or as a fund, it really is hard to move the market in a certain direction. So there is more transparency in that market, and it does offer an ideal condition for competition between those participators in this market. Now, what we're looking at in the market, it basically gives us the relative value of the world's exchange rate. So, and it keeps on changing. The beauty about this market is that it keeps on changing. The Forex market keep on moving, keep on changing. So as traders, this is what we're after. We can profit from a market that doesn't really move when we're talking about Nadex options or on the binaries as an example. But as traders in an overall, we need the market to move. We need to have some moves in the market so we will find opportunities to enter and we can capitalize on those moves. So what we're after is that ever-changing prices. And it really is, there's a lot of effect between, there is the fundamentals behind what do we think is going to happen in a country economy. So if we're talking about the euro dollar, do we think that over the next couple of days, over the next couple of weeks, or even the next couple of hours, there are going to be some news that are going to affect this market, and am I going to think that these news are going to strengthen the US dollar, or actually I think that these news are going to weaken the US dollar? Part of the things with this market as well is we're seeing a lot of intervention. The relationship between the interest rate between the Eurozone and the US is also an effect on this market. So there's a lot of fundamental reason that comes into the market, a lot of expectations from trader of what the central banks are going to do with expectation of how it's going to move that market. So that is coming from a whole fundamental approach. But what we like to do is from a more technical approach. So it doesn't mean that we're not going to be aware of economic news. So things like non-farm payroll will affect this pair, things like interest rate decision, Fed meeting published, and also the ECB meeting published, and all sorts of declaration about what sort of intervention they are willing to do is going to affect this market. But we are going to look at technical ingredients of how we are able to anticipate in advance where this market can go. And as investors, we're probably looking at longer term type of trade, but as traders we can also look at very short term type of trading. The cool thing about this market is that it's actually open 24 hours, 5.5 days a week. So whenever you come home to your computer, there is a market in the currency. So if, for example, you're working during the day, it's really hard to trade the US index on an intraday basis when you're at work. When the market is open, you come home, that market is already closed. So yes, you can trade the Globex session, you can trade the futures of that market, but it's really hard to do it on a 1 minute, 2 minute, 5 minutes type of trade because you need that liquidity in the underlying market. With the Forex market, you still have that because this market is not closed. This market doesn't close until the weekend comes. So it opens in the morning of Asia on Monday morning, and it closes around 5 or 4 New York time on Friday afternoon. So it's open all through that time. So you've got about 5.5 days. So when you're coming home, no matter what it is, there is someone around the world that is this morning for them, and they are trading this market. So it's starting in Asia, moving through to Europe, and then in the US, and coming back to Asia again. So there's always a trading then somewhere in the world. Now, when we look at the currency market, we've got the binary options that are available on most of these major currencies, and we also have the availability to trade the spread that are available on another set of currencies as well. So there's a lot of options, a lot of market for us. We don't necessarily have to look just at euro dollar. It is the biggest one by sheer volume, but or size, but there are other options that are available for us as well to look for trading. We're going to concentrate more on euro dollar today, but I'm also going to give example from other currencies, and really these technical ingredients that we are looking at, it really applicable to any market, any time frame, so we can understand the technicals behind it and take it into a different currency market or index market altogether. So a bit about the euro dollar. Now, the euro dollar, it started in 2002, and it is one of the world's youngest currency pair, and it obviously started when the European Union decided to put their currency together and create the euro. The 19 countries is no longer true. We have more countries in the Eurozone currently, and it is one of the biggest partners with the US. So it is now the second second largest reserve currency in the world after the US. So it has a huge implication on the currency market. And you can see the difference in the size of this other market versus the euro dollar. So you've got euro dollar, and then after that dollar yen and pound dollar. So all of these currencies are really big and quite volatile. You've got the other ones as well, and then obviously the smaller ones sitting somewhere around here. You can see that the sheer size of the euro dollar is almost twice as much as the next one in line, which is the dollar yen. So what are the benefits of trading the currency market? So what we want as traders, we want opportunities to begin with. We need the market to move. We want to find trading opportunities. That's how we're looking to capitalize in the market. Now, what we also want, we don't want to be guessing. We don't want to say, I like this because I feel good about it, therefore I want to enter and I want to buy this long. I want to have reasons, and I want to have as many reasons as possible to confirm my view that, say, for example, from here on, this market is going higher. So what I'm going to do, I'm going to have stacking that probability in my favor by adding more and more and more reasons for that market to go in one direction over the other. Now, another thing that I have with this, with the currency market, is that it moves. When the market moves, it moves. Sometimes you'll have things like, the index market. It will move nicely, but it wouldn't give you enough opportunities, or it's not open in the time that you would like to trade. There's not enough liquidity in the market. Some commodities, as an example, don't offer enough liquidity during that time, so the moves are not that great. The price action in the currency market, I'll put it this way, it's more smooth because you have a participation all through the 24 hours a day that this market is actually open. So you've got a more smooth price action. Now, one of the things that we are after when we're talking about a trading opportunity is that I want an optimal chart structure. Okay, so when I'm talking about optimal chart structure, and I'll show you later a couple of examples, I want a market that doesn't have gaps. I don't want market that have big wicks in it, or a big indecision candle, or big candles all together. So all that erratic and uncertain behavior, and a lot of that come from illiquidity in the market. So when I look at the Forex market, I get more smooth and nice price action. It also can fit around my lifestyle, so I don't have to twist myself around to have it fit on a certain time of the day. It's always there. It's always there, and it's always open, and there's always a country that it's the day there, and they're trading that market. So there's not much conflict between that and your everyday life. And one of the problems that we found with new traders is that they try to match their life into whatever market they want to trade because someone told them that this is the best market to trade, or there's the better opportunity there. But actually what we found is that it really is better to let trading match your lifestyle than the other way around. Let me pick up a question. How to determine the payout amount upon execution of trades? We're going to see exact examples for that. So we're going to discuss that, and I'll remember that question. And if I haven't, please type it in again as we see examples. So right now it's a little bit of an introduction, so I don't want to jump into the end of the presentation. So we're going to go into concrete examples, and then we're going to talk about how we pick up the binaries or the spreads, and what sort of reward to risk we are looking to get out of that scenario. So we're going to talk about that towards the middle part of this presentation. All right, so coming back to the benefits of the currency trading, even if you're just starting, even if you're new to trading, it's a great market to consider. So you'll find that new traders come to the currency market just as much as experienced traders spend time in the market, and you can do all of those. You can look to trade the currency of the commodities and the index market all from the one account with Nadex. Now, one of the things that you can find with currency market is that they react quite strongly to pieces of news. So say for example UK, I think it was yesterday, came out with better than expected some sort of data, and then the pounds got stronger. So there's a reaction to that news, and this market is ever flowing, ever moving. Now, trading news on a traditional sense of way can cause slippage and can cause gaps, which mean you're going to exit or be taken out for more than what you planned for. So your risk is increased. When you trade in binaries or when you trade in spread, when you trade with Nadex, your risk is fixed. So it doesn't matter how much there is a reaction in the market, your risk is fixed. You're not going to lose more than what you've put on that binary. And it's a very, very huge advantage when you trade in a market that is extremely volatile, or when you're looking at a reaction to news. And sometimes the market can move so sharply, so quickly, that a regular stop loss will just be, flown in that big push of the market, and you end up with a much higher risk than what you planned. But it doesn't happen with Nadex contract. You will still, doesn't matter if it's closed against you 1 point or 200 points, you're still going to end up losing the same amount. So it's a very huge advantage. Controlling our risk is very important as a trader. So let's have a quick understanding, a little bit about the spreads and a little bit about the binaries. So when we're talking about the euro-dollar spread, what we'll have a range. So as an example, I'm looking here at the range of 1.1340 to 1.1590. And this is the range that I'm after. Now, what I like to have when I'm looking at a spread, when I buy into the market, I like to buy at the floor, because that gives me the whole entire size of the spread as my profit. When I sell, I like to sell as close to the ceiling as possible. So if I'm looking at a spread and I'm somewhere in the middle, I might think to look for a binary, because that reward to risk is not as great as it could have been if I was on the floor or if I was on the ceiling for a sell. It's a less volatile approach to trading. It also gives you, it caps on your profit as well. Just as much as we're capping the risk, we're capping the profit, because even if this euro dollar is going to close above this level of 1590, we are not going to get more than that 1590. So we need to be aware of that. But the point of a spread is that it gives us a nice area for the market to move, and it's a variable payout structure. So it does depend on where the market closes of our payment. Binaries are not like that. Binaries, it doesn't matter if it closed a little bit in your favor or a lot in your favor, the payout will be the same. And it doesn't matter if it closed a little bit against you or a lot against you, the risk that what you're paid for that will be the same as well. So you can get a lot of more options for binaries than you can get for spread, simply because there are more binaries available for us. So what we can also look to do is choose maybe a more cheaper binary out of the money, and then with a view that this market is going to go a lot higher, and that can give us a nice reward to risk. We're going to see more example actually on when we talk about the charts themselves, so it will be more clear. It wouldn't be just out there in the air. But for what we do need to remember from the binaries, it's an all or nothing expiration. Okay, there's no variable payment. It's all or nothing. It's 0 or 1. Okay, so if there's any questions about the introductions, please let me know. Otherwise, let us jump in straight into the advanced technical analysis. And the first thing that I want to start with is trend analysis. So what we're after is a market that is moving. So we know that there's no guarantees in trading. There will not be a trading strategy that wins us 100% of the time. It's all about probabilities. And what we're looking to do as traders is stack the probabilities in our favor. And as I said before, one reason is not enough. What I want to do, I want to build up on those reasons. Now, one of the strong things that I'm looking at is a trend. And funny enough, when new traders come to trading, they look at trend analysis. It's not complicated, and because it's not complicated, because it's quite simple to see, they deem it that it's not important, because we have this tendency to think that if something is very complicated, then it must be better. It's not like that with trading. Trading doesn't have to be complicated and hard to understand. Trading needs to be about flawlessly executing your trading strategy time and time again. It's about consistency and it's about discipline. So when we're talking about trend, it can be the single most important technical tool in our arsenal. So let's have a look. When we're talking about an uptrend, we are talking about a clear series of higher highs and higher lows. And there's a strong assumption that comes within an uptrend, and that is that until I see reasons that this market is running out of momentum, then I can look to take it to the high side. So I can look to go long that market. I wouldn't decide suddenly that I want to short this market if there's a very strong momentum to the upside. So that can keep me out of bad trades, but it also can give me a strong indication of the direction of this market, because if the market right now have put in this new higher low, then my expectation from an uptrend that it's going to go ahead, take the previous high and give me another higher high. It's a very strong assumption to be trading with. Quite similarly, when we're talking about a downtrend, we've got a clear series of lower highs and lower low. So what is my assumption when I've got the new or the next lower high in this market? The assumption is that this market is going to go down and give me another lower low. It's a very strong assumption to be trading with. And then we've got a no trend. No trend is when it's anybody's guess when this market is going. And I'm not talking about a market that is stuck in a range, because with Nadex binaries, you can actually look to trade a range, and it's quite a nice scenario as well, where I wouldn't do that just buying into the market or selling into the market. It's a nice scenario with binaries. But what I'm talking about here is an area of no trend where it's anybody's guess where this market is about to go next. Is it going to make another higher high? Is it going to make another higher low? Nobody knows, and that's why we not like to take opportunities in this sort of market, because it reduces my probabilities, it reduces my assumption that the market is going to go on one direction versus the other. So the first thing was trend. The second thing that I like to look at is multiple time frame. Now, the problem that new traders come and look at just one time frame is that you can have and you can spot the most beautiful opportunity that there's out there to enter into the market higher. Say you're looking at a 15-minute chart and you go, this is a beauty, this one is going higher. But when you don't look at the overall direction of the trend, you can get caught up in a landslide that's coming down on that market. So what do I mean by that? If you think about, say, a 4 hours chart, at some point a 4-hour chart, as it's going down, it needs to pull back. It needs to release some of that selling pressure and pull back. When the 4 hours starts to pull back, what is going to happen to the 15 minutes? That 15 minutes chart is going to start to change direction. That 15 minutes chart is going to start to uptrend. Does this mean that now I'm going to trade it higher and I'm going to get multiple targets out of that one? Probably not, because what this 15-minute chart is doing is representing the pullback on the higher time frame. So the overall direction is to the downside, but the lower time frame are changing direction while the higher time frame is pulling back. So trading with just one time frame is very, very dangerous. So what we like to do is look at our trigger chart and then have a confirmation chart, which is a higher time frame that will confirm the direction of the overall trend, that we're still trending with that trend. So that is one reason why we're looking at higher time frame. The second reason is that levels of support and resistance are going to be more apparent on those higher time frames. So remember, levels of support and resistance, that is like an obstacle. That is like a wall that sits between your opportunity and a continuation of that move. So we don't want to do that. We don't want to enter into an opportunity just to hit into that wall and that will reverse and take us out. So levels of support and resistance will be more apparent on those higher time frames. So just as an example, what you can see here is that the Aussie dollar is in a very nice and strong downtrend over here, and you can see that the downtrend is also continuing on the 60 minutes. So a pullback after this big sell, identifying the next lower high in this market, and off I go to sell it because the higher time frame is confirming the direction of this trade. Now, what we like to do is trade with the direction of the trend. It has more strength. It is like swimming with the current versus going against the current. And one of the things that we're looking at is we're looking for those areas where the market, you can see every time the market is pushed higher, it's like when you take a ball and you throw it up in the air, you throw it strong and it starts to keep on moving and moving and moving. At some point it will come to a halt and then it falls back into the ground. And it's something similar that the market is doing. The market is pushing higher. At some point, we need to have some release of that buying pressure. So we're going to have a bit of a sell-off. That doesn't mean that this market is reversing and going down right now. We just let's have a breather before it picks up again and moving higher again. So what I'd like to do, and this is one of the things that the trend flow strategy that we're teaching on the advanced course is there to do, is identify those area, those higher low area, and look for the continuation of that momentum. Because a lot of the trading strategy, what they do, they look at the break of this high. So say we're moving up, we're making a high, we're pulling back. What they say is this uptrend is confirmed if I break the high of this previous high, giving me a higher high. So now I'm entering somewhere around here. My stop loss will be somewhere around here, and I only got this tiny little move to go. What if I can identify this area as the turning point? Instead of here, the confirmation of the higher high, what if I can do that here? What if I can find this area here? Look at the nice moving bullish move that I've got from here. So this is what I'm trying to do. I'm trying to find out the next higher low in an uptrend so I can take this market higher, and the next lower high in a downtrend so I can take that market lower. So I want to enjoy that full buying momentum that I've got. I will not be caught up in that selling retracement. To do that, I need to have my technical ingredients. So when you trade with the direction of the trend, there's ample opportunities for us to take this market higher. If we will just be going sideways and in any sort of direction, it's going to be quite hard to identify what's going to happen in the market next. But what you can see from this example is every time we're pulling back, making another higher low, we're pushing higher, making another higher low, pushing higher, making another higher low, and pushing higher. So what is the likelihood of this market to do while we still have the momentum of the trend? So that's important to remember, because trends do get broken. So I need to be able to assess if this is still a good, strong momentum trend, or actually this one is running out of momentum. But the assumption is that as long as I don't see a reason why this market is running out of momentum, I'd look to trade it as the market finishing this selling retracement, and I look to take this higher. The next element I want to look at is support and resistance level. So what are support and resistance level? Well, there are structure in price that help us identify a potential decision point. So when I talk about decision point, it's points on the chart that we have seen the market react to previously. What I want is a well-defined levels. I don't want sloping trend line. Why don't I like sloping trend line? When you think about levels of support and resistance, the reason why there is reaction for those levels is because everybody are seeing the same thing and they're placing their orders in and around those levels. So what we're after in this case is not to be unique. What we're after is to be able to see what everybody else's are seeing. Now think about it this way. If you look at your computer and you look at the euro dollar chart, and then you look at your phone and you look at the euro dollar chart, you've got different amount of information that you can see on each of those devices. Now if you try and put on your sloping trend line, so basically connecting the highs and the lows in a trend, because you see different information or different amount of information, what you'll end up doing is connecting different highs and lows with your smaller device versus the large screen device. When you as one person see two different levels or two different lines that you can call support and resistance as a sloping, then what it means is that if you see different things, what about the rest of the trading community? They also see different things. So if I see two different lines, which one is the right one? And how do I know if there actually is reaction to that level, or I'm the only person who sees this? So looking at sloping trend line is not strong enough. So what we are after is what we call true support and resistance level. So what are true support and resistance level? There are levels, flat levels really, that have been tested 2 or more times. So what I want is the market to have clear touches and quite specific touches, and that is obviously within a few ticks or pips or points from each other, but it needs to be visually in and around that level. So if I draw a line connecting, I will get a nice flat line. This is a strong level of support and resistance because everybody can see it. So that's why we call it a true level of support and resistance. And the more touches I've got, the stronger the level will be. So let's have a look at this example. So true resistance is defined by 2 or more touches at an upper specific level. So let's have a look. We've got a touch here and then the market fell. So far there's nothing there. As the market comes up here again, we've got another touch. Market fell. Now I've got 2 touches on this area, so I expect it to be resistance, and you can see the market came up and found resistance yet again at that level. Quite similarly, what we've got is with true support. We've got 2 touches at quite a specific level. You can see that the market was coming from a downtrend, touched this level quite nicely and specific, and started to change direction. So market is reacting to those levels, and the reason for that is because, well, traders seen those levels and place their orders around those levels. So it's sort of like we all see that level, we expect a reaction for that level, and then that's what happens. So it's kind of like a following sort of scenario that everybody expects a reaction to it. Obviously levels can be broken. I mean, they don't stay there forever. I think like news can just smash off through very, very strong levels. But when we're looking at trading, we're looking at stacking the probabilities in our favor. So if we know that there's going to be some reaction to a level and we're just about to enter shy of that level, then what would it do to my opportunity? Most likely it's going to fail because it's like a wall there in the way of my target. But what if I'm looking to go long, as an example, and the market just bounced off support? Then it gives me extra protection for my stop, and it increases the probabilities of this market to go in the favor of my direction, therefore going long. So levels of support and resistance are very important to us. Another golden rules of support and resistance is that when support is broken, it becomes resistance. When resistance is broken, it becomes support, and that adds a lot of information for us. So if, for example, the market is coming up into this level, we've been there before, it was resistance, turn into support, now coming back into resistance again. If I'm coming into this market is now trending lower, and I can see this market coming up and touch this, then I have in high likelihood that this market is going to find resistance over here and fall from it. So it adds us another element for our trading decision. Let's have a look at historical support and resistance level. Now, the nice or really interesting thing about euro dollar is that it also reacts to round number quite beautifully. You'll find it that it's now stuck around that level of 1.1. We really are moving in a range in euro dollar for the last couple of really months. The euro dollar is stuck in a range, it's a narrowing range, but we're reacting quite strongly recently to the 108 and the 1.10. So we found that levels of support and resistance also come around round numbers, so numbers that have a lot of zeros to them basically. But when we look at this example over here, you can see that the market reacting to these levels over here. So this is currently the 1.34 it looks like on this chart, and we have a nice reaction to that level. You can see it coming down, react to that level, and that can help us predict what's going to happen next in this market. So euro dollar works really nice around this lovely round number. So what you can see in this reaction is that we have here the 1.3480 currently, so in and around the 1.35. What you'll find is that the higher you go in the time frame, the closer you can sort of look at it as coming close to the round number. When you go down the time frame, you need to be a bit more specific with your levels of support and resistance, because 20 pips in this scenario can really mean the difference between a winning trade and a losing trade. All right, so you can see that we've got here the support from the 1.34, and we know that we can look to take it higher to the 1.3480. Now I've got here a rejection candle. If it closes nice like this, then what I can look to do is I can look to sell this market and expect it to come down into the 1.34. Now, would I look to take a target further than that 1.34? Probably not, because I've got a level of support and resistance as an obstacle in the way of my target. But if I get a confirmation that we're actually rejecting this level and looking to push lower, then I can grab a trade out of that move and look to take it as profit around the 1.34. So knowing these levels of support and resistance can really help us in assessing where to for that market. Another thing that can help us in advance assess where the market is going to bounce from is pivot levels. So what are pivot levels? Well, they started from the P-trading before we had electronic trading on computers, and they calculated on the last day of price action. We also have the last day there will be the daily pivot, the last week will give us the weekly pivot, and the last month will give us the monthly pivot. They're very popular, especially when you're looking at index markets and also on Forex market. And they're also, because everybody are looking at it and everybody expecting a reaction to it, then there is some sort of a reaction to it. So when we're talking, for example, on the daily pivot, then the calculation, it's basically the high, low, and the close divide by 3. But you can, most charting will give you that as you just add the pivot into it. You don't have to go ahead and calculate it on your own. So this also becomes somewhat of a levels of support and resistance. Personally, I like to see them when they've been tested. Obviously, with the daily pivot, just as the day change, they haven't been tested yet, but as the day progress, you can see the reaction to these levels and you can start to form a trading decision around them too. A question, where to get such charts to show support and resistance level? So we draw them on the chart, so let me just go back there. So this is, when you just look at this chart, this is the 4 hours chart for euro dollar, and what we do, we just draw these lines, and the way we draw them is that we look at this chart and we go, okay, what line is going to connect as many touches as possible? This is really how to draw a level of support and resistance. I need to see if there's many touches that can connect that level, and obviously it will be within a couple of ticks or pips in the case of currency. You can see that here it's penetrated a little bit underneath. You can see that here it's a little bit above, this one quite precise, this one a little bit below. It's all in and around, so we draw the line that best fit. So the chart itself don't do that for you. We do that. We draw them. I mean, you can find some charts that will identify those flat levels for you, but personally I find that I like to find my levels on my own because I like to make my own decision. Do I like this level? Do I think this level is not as strong as the level up above if I'm looking at a higher time frame and so forth? So this is part of what we do as traders, is we put our levels of support and resistance on the charts. Okay, so if that's not clear, let me know. All right, coming back into pivot points. So when we're looking at pivot points, the first one that we get is the pivot itself. And then we've got 3 resistance level, R1, R2, and R3, and then 3 supports level, S1, S2, and S3. And we're looking for reactions around that. Some traders look at the pivot as being the more important one, and the further away, then the less important one. It's all up to your choice. I do think that they look quite the same. The price seems to react to them. I mean, if the price, for example, from here starts to rally higher, then the pivot will not mean much, and the R3 will be the one that I'll be looking at. So it's all in and around of where the price action sits at the moment. What you can see in this example, we're looking at cable, which is the pound versus the US, and you can see how the market reacts to those pivot points. So those pivot points are being drawn on the chart. This is this little dotted line over here, and you can see the market reacting to those. Now, sometimes you'll find that a monthly pivot point will sit on top of a daily pivot point. So that makes it like a double point. It makes that level just a tiny little bit stronger. But if you know that there is a pivot over there and you're looking to enter, it's just one more thing, one more level that can add into your trading decision to say the market is either going to bounce from here or going to find resistance here and continue the downtrend. It's just another element that builds up into our trading decision. The next element that I want to talk about is Fibonacci level. So the Fibonacci levels is used only on trends. There is no meaning to look at Fibonacci retracement when we don't have a trend. So first of all, we need to have clear series of higher highs and higher lows, or clear series of lower highs and lower lows. When you think about the Fibonacci, it's about that series, the math series that starts with 1 and 1 and 0 and 1, and then what you end up is you add the last 2 numbers and you get the next one. And that's how this series continue indefinitely. When we take the bigger number and we divide it from the one next to it, what we get is the golden ratio. We get the 1.618. And if we take the other one, so if we take the small one divided by the big one, then we get the golden ratio of 0.61. Why is it called the golden ratio? This is the beauty of the Fibonacci series or Fibonacci line, because the relationship, the mathematical equation of how to get the next one in line is quite simple. Is take the last 2, so n plus 1, and then you get the n2. Okay, so that's how you calculate the series. And the interesting thing about it is that the relationship between each 2 adjacent number is the same. When you start with a smaller number, it's going to be a little bit off from that 0.618. The bigger the number, the closer you are going to get into that ratio, until that ratio really comes time and time again. So that's why it's called the golden ratio. And where else you can find it? You can find it in nature as well. You can find it in the ratio of the wave. You can find it in the distance between our arms and our body. You can find it the distance between the eyebrows and the eyes. Everywhere in nature, in the spiral of the galaxy, that's the ratio as well. So it's a very interesting formula, and it also happens in the market. Now, the question always comes, did it happen in the market because that's how the market works, or is it happening in the markets because traders expect it to happen? The answer is no one knows, but the end results stay the same. It happens in the market. There's reactions in the market. The way you get the rest of the ratio is you take your square root out of that 618. So that was a quick math examples. But if we come back into our trading, we're looking at a couple of very important retracement. So the 38.2, the 61.8, and the 78.6, they're all related. The 50% is not a Fibonacci retracement. It has nothing to do with the Fibonacci series. What it is just the middle point. So that's why 50% is sitting there as well. So every time you plot the Fibonacci retracement, you'll get a 50% just because it's the halfway. When we're looking at where a market can pull back to, because remember, we're looking at a trend, and we say, for example, we're looking at an uptrend, and we want that uptrend to pull back to have release of that some buying pressure and give us an opportunity to enter enter long again on that higher low. So we want to predict in advance where that higher low can come out around so we can capitalize from that move. So if we're looking at an example on a 38% retracement, we look at it as a bit more of a shallow retracement. A retracement into the 78.6, that's more of a deeper retracement. So we're looking at that area between the 50 and the 62%. We call it the sweet spot, and we look for retracement in and around that area. We would also like to have, when we look at our moving averages, for example, we want to see that moving averages that we're using, and I'm going to talk more about that. We don't have time for that today in the advanced course, but what we would like to have is combination of that. So I still would like to see my moving averages in a nice fanning order, and I'd like to see my market coming back into the buy zone in and around the area of the 50 to 62% being our sweet spot. So if I'm drawing in the Fibonacci line, and I can see before the market even started to reach around that area, there is something sitting. I've got a previous touch here and somewhat of a touch here. Maybe there's also a pivot sitting around this area. So I'm starting to build up into reasons why this pullback might stop around this area. So I'm building more and more reasons why the market in this uptrend going to find support around that area, going to continue higher from there, basically giving me the next higher low. And you can see the beautiful reaction that the market has to that level. We're bouncing really nicely off that 62%. It doesn't always jump straight out to the 62% and then retraced higher. Sometimes it's a little bit above, sometimes a little bit below, sometimes it doesn't even come close to the 50%. We're all talking about probabilities here, and what we're trying to do is predict the market rather than chase the market. So coming out somewhere around here is already too late. Look at the beautiful move that this market has already done. I could get a nice reward to risk just by having that move. So how else can we use this, or how do we draw the Fibonacci in a trend? So in a downtrend, what we can do is we always take it to the extreme. All right, so what we'll do, we'll take it from the previous high and we'll draw it on to the extreme. If I want to take another Fibonacci retracement and take it from the previous high, and I will draw it all the way down to the extreme. And if I've got two retracements that cluster in at the same level, well, that also increases that level, that support and resistance level that I'm after, to see if the market may stop its retracement there. So looking at this example, what we can see here, we've got this nice pullback, or pushing back over here, and then a pullback. If I draw my Fibonacci, I get the sweet spot sitting around here in between the 50 to 62%. We're still coming in with bullish candles, by the way. And what you can see, market reacting to that level, spending a little bit of time, a bit more push, and then falling down to give us another lower low. So if I had another Fibonacci taken from here all the way down, and maybe now the 50% is clustering with that area, that gives me another strength to that opportunity. So this is just an example to see these Fibonacci levels in action. And you can see we need to draw from the low to the high, to the extreme in an uptrend, and we'll do that from the high to the low in a downtrend. What you can also see in this scenario here, we came into the 50%. Look at these rejection candles, two rejection candles of that 50%, and then a break lower. So when I've got this sort of scenario, I've got a touch here. There really is any sort of nice touches around this area from these candles. But when I have another touch here and another touch here, if I come to this market, I see this nice rejection candle over here. I can see that it's rejecting the 50%. A break below the low of this candle could very nicely signal a continuation of this downtrend. So looking very nice just by building all of those reasons to enter into the market. All right, let's look at combining these ingredients. Let me see, before we head into the examples. All right, let's go through combining the ingredients, and then we'll have a quick break. Okay, so how do we use all of those ingredients to help us identify a nice opportunity? So let's take a look at this example. What we're looking at here is the 1 hour chart. And you can see that from this low to the high, what we're seeing here is a pullback into this 50%, into the sweet support area, the Fibonacci buy zone. And what you can see is the market reacting into that level. Now, can we take it any further? What we need to do, if I want to see if there's a Fibonacci over here, I need to take the low, the Fibonacci from the low to the high and see where it's pulling back to. So what you can see over here is that I've got another Fibonacci going on here and a pullback into that sweet spot and a nice move away. So what I'm after is, again, can I take this one next time? Can I take the Fibonacci from here, pushing higher, pulling back? How far does this one go? This look a little bit further. This look closer to the 78. You can see that now, though, it bounced off a pivot. You can see that this Fibonacci over here also offers us a pivot. So there are a couple of things going on in this scenario. There's the Fibonacci and there's also the sweet spot as well. All right, so we had a nice move out of that one. Now we can take the next fib over here, and you can see that this fib, as I said, it's pulled a bit further. It's closer to the 78. What else do I have here? I have here this this pivot over here, and I've got here these previous touches. So when we have the candle, I mean, it pushed higher and closed above the 62. But when I've got a deeper pullback such as this, and we've already been in a nice uptrend, then I start to wonder if the deeper pullback means that we're running out of momentum. I'll start looking at different ingredients. I'll start looking at convergence and divergence. I look at the higher time frame. If the higher time frame is so very overextended, I might let this one go. So even though it gives me a rejection candle, what it did, it bounced off a much deeper pullback. So I need to add more reasons. I need to look at higher time frame. I need to see where we're sitting in the levels up above, because what I also have is I've got somewhat of a level up here. So would that mean that this level right now, this level over here is going to be a level of support and resistance in the way of our target if I'm entering off here? So there's a couple of questions on this fib 3 that we have, but let's see what this this level has done, and we can see that this is the entry. And where can we look to take that from? If coming back into the chart, this is the levels that we are sitting at. So it's 1.3430. Let's see what sort of scenario can we look to trade this one higher. All right, so when we're looking to trade this one higher, we know that our support is sitting at 1.3430. Now, as I said, there is a somewhat of a level forming over here at this area. So if I'm looking to take it, I might consider the time frame that I'm looking to take it, and I might consider to take my first target before I'm coming into this high over here. But let's assess, just for this example, what sort of spread am I looking to take out of that one. So I've got the spread that starts at 1.3460. I've got the 1.33 and 35, and I've got the 1.32 and 10. Now, what I'd like to do, if you remember, I'd like to buy as close to the floor as I can and sell as close to the ceiling as I can. So there's not many spreads that are available for me currently. The only one really that is closest to the floor is this one over here. So I'll be looking to buy this one if I think that this market is now going higher. What if I choose a binary option? Then there's more things that I can do with the binary. There's more options that are available for me. There's more expiration strike price that are there for me. So if this is where the market sits right now, then let's take a look what I have as an option. So the next one that I've got is this one, the 1.3436. Okay, this is the closest to where this market sits. But if I think that this market is about to go really high from here, give me a really strong reaction, then I might choose to take this the next one up, which is sitting at the 46 or even the 56 or the 66. It all depends on my assumption. As you can see, the further out of the money the option is, the cheaper it's going to be to buy, so the higher reward to risk I'm going to have. So we need to, when we're looking at which contract are we looking to choose? We need to have a view on this market. Is this market going to move sharply higher from here, or is this market going to move a little bit higher and stall around some sort of a level and then continue higher? And how much time do I have until expiration? Because if I was looking at the 1 hour chart and I've got 16 hours to go, then even if the market is going to spend a little bit of time at that small resistance level, I still have the view that this market has a strong push in it. I might look to take one really out of the money option to give me a high reward to risk, so I can break my risk into one out of the money option that can give me a really good reward to risk, and then the second half I'm going to do on something that can give me a one-to-one reward to risk, so I can remove risk from the table while still allowing myself to enjoy a nice move in the market. So we need to consider how long does this option have until expiry, what do I expect this market to do, how further do I expect this market to move, and in what time period do I expect this move to happen. So this is the result of that scenario, and you can see that the market has reacted to this area over here. It came down, so if I was to take this and there was only 3 or 4 hours until expiry and I haven't taken my profit somewhere around here, then I would have expired worthless on that level. But if I had 16 hours to go, maybe that would have worked, but then if it's expired somewhere around here, then mine again expired worthless. So I need to be able also to manage my position. That is why I'm looking at removing risk from the table, and it could be excuse me, that if there is the market has reacted really sharply and reacted within 2 or 3 hours and there's still 16 hours or 15 or 14 hours to go, I might choose to close my position. Yes, it hasn't expired at the full profitable scenario, so if I'm not at expiration, I can't get to that 100% when we're talking about binaries, but maybe I don't want to take that risk when there's too long for the market to go and too much can happen in that market. So again, we need to also be able to manage our trade while we're in a profit in that trade, depending on how long is left for that market to expire. Okay, so what we're after in the market, what the whole rationale behind this method is that we want to take the path of least resistance. We want to go with the direction of the trend. We don't want to be the one that's standing there selling where the waves of buyers coming into the market is going to wash us off. The next thing that we want to do, we want to be able to identify turning points in the market. So those higher lows or lower highs in the market that will the market would in high probability react to, so anticipate them in advance and be able to take an opportunity of those levels. The stronger the level or the cluster, let's put it this way, so having a level of support and resistance with a double Fibonacci, with a pivot point in it, and also in a nice area with the moving averages sitting there in a nice buy zone or in a nice sell zone, all of this adding up into building a high probability trading opportunity. So what we're going to do now is going to look at a couple more examples. So I'd like to take about a 10-minute break before, or I think 10 will be a bit too much. Let's take a 9-minute break. We're 2 minutes past the hour. Let's come back at 10 minutes past the hour. I'm just going to fill in my water bottle. And if there's any questions about those levels, if there's any questions about building up into the opportunities or understanding the technicals behind them, please just feel free to type them in a question box during the break, and I'll pick them up as we come back from the break. I'm going to put a little clock here to identify the time so everybody knows when we're coming back. Let me just get that going. So we'll come back at 10 minutes past the hour, 8-minute break. Okay, welcome back. Let me pick up a question that came through during the break. So it's a more of a general question, but I think it's a good one. If I were a person just getting into trading besides a demo account, where else would you recommend a beginner to start as far as gaining common basic knowledge? So I'm going to tell you more about it, but Nadex actually running a free premium education course. So this is completely free for Nadex clients. And what we do in that course, we talk about a bit about the trader mindset, which is really important. And then we talk about more technical ingredients. And then we look at 2 complete trading strategies that we're trading the contracts with, so finding trading opportunities. I think it's a really, really good place to start. You'll find that if you'll just go, blogs on the net or tons of book about technical ingredients, you can, obviously do that, but there's a lot of information out there and some of it can be very confusing. I think the best way to learn how to analyze the chart is actually looking at the chart and start to understand what the market is doing. So instead of relying on external information, really rely on your own knowledge, and that comes with understanding technical ingredients and technical analysis. But having said that, not every book about technical analysis will be a great book because the whole thing about trading is that you can have these massively complicated indicators that no one understands the math behind them, and they don't do anything different. So the real beauty about trading is understanding that tug of war that happens between the buyers and the sellers in the market. It's about reading candlesticks to give you that information. It's about understanding trends and the momentum in the market, and when a market is running out of momentum, where to look for as levels that the market might react to and push from and react to and all that sort of things. And I think that if you'll join us on that advanced course, you'll get a bit of understanding about the technical analysis that we're looking at, because it doesn't need to be complicated, but you need to be able to understand and then practice it more and more and more. It all comes from practice. So you need to have good basics, and I think that will be a really great place to start. And then you can decide what else would you like to do. One of the things that I will say is that a lot of trading is behind psychology. So the psychology of trading is very important. It's not just to tell me if there's a dragonfly bar or this is a hammer. This sort of thing don't matter. What matters is what happens in the market. So who won that candle, who won that chart, and how are you as a person going to react to the information that you're reading? Because 2 people seeing the same charts, 2 people have the same knowledge, and they will choose to react differently. One will be disciplined and patient and wait for a good opportunity and flawlessly execute their trading strategy, and the other one will be jumping the gun and feeling afraid and feeling greedy and risking too much and exploding their entire account. So it's not just about the technicals, it's a lot about the trader behavior and understanding around that. So join us on that advanced course. I think it's a really good place to start, and then you can see how to branch from that as well. And practice and hours in front of the chart, understanding price action. I hope that helps. I hope that answers your question. Okay, so what I want to do now is get into more strategy examples. So this strategy is not a complete one. There's more elements that we would like to add into that, but I just want to give you, just by looking at these a couple of things that we covered really quickly, is there something that that we can do? Can we utilize this to increase our probability of our trading opportunity? And by the way, guys, this is a massive storm that starts here. So if for some reason my internet get disconnected, it's because of that. But let's hope we'll be okay for the next hour. All right. So what I'm looking for is this couple of elements that we're after. We're looking for levels of support and resistance, pivot, Fibonacci, and I want them to all cluster. Obviously, I'm looking at a trend. If there's no trend, I wouldn't want to be trading this. But mind you, saying that, I do like trading in when the market is really going sideways. So if you look currently, these examples are a little bit older, but if you look currently as where the euro dollar sitting, if you look at it on the weekly, on the daily, we're stuck in a range. We are in a range, and we're coming up. We're trying to test the 1.10, and we're unable to do that. We're falling back from it. On a regular sort of trading, it might be a bit more complicated to identify where the market is going to be selling off from. But if we are looking at it from the perspective of binaries, then if I know that the market is going to be reacting to that level, and it's been a very strong level in the past, and I've got overextension on the higher time frame and all sorts of other things like that, then I can look to sell that binary from that level. So there's other things that I can do utilizing Nadex contract in a market that moves sideways, and that is just a side note of where the market is currently sitting. It's very hard to find a nice trending flowing in euro dollar currently. I mean, it starts a nice trend and then it breaks it as it reached that level. So there are other things that we can utilize. Knowing all of that information about support and resistance level and about reactions to these levels. So let's take a look at this example. So what I've got here is I've got the 4-hour chart, and you can see that I'm coming into a level. I'm coming into the 1.12 level, and could that be resistance right now for the trend? This market is currently, you can see, is in a downtrend, making high, low, lower high, and lower low. Would this be the next lower high, this area? So if I break it down into the 1 hour, let's see what we can spot here from the 1 hour. You can see the reaction that this market has around that area. So this is the sweet spot, the 50 to 62%. And what you can see is that we're spending a couple of good candles around it. Now it's not just a sideways action what we see here, because you can see that every time we're coming up, we're quite very obviously rejecting these levels. I've got big wicks to the upside that's been rejected, so more sellers are coming into the market at this point. So there's I've got this 1.12 level. It also sits somewhere around that sweet spot on the Fibonacci retracement. Let's see what else do I have here. I also have got a weekly pivot that sits at this level. So currently I have 3 elements that's saying to me higher likelihood that this market is going to find resistance at that level. Now looking at the reading of the candlesticks, I like the fact that we are rejecting this on this lower time frame. This, when we look at the 1 hour trend, 1 hour chart, there is no trend. You can see that this trend is it's pushing lower, but it's not a really nice trend currently. So you can't really say as I'm trading with that flowing 1 hour trend, but there's a lot of reason why this market is potentially going to go lower from here, because it's finding resistance, it's reacting to a level. So now this is our assumption of where this market is going to continue from. Let's see what sort of contract should we look to take on this one. So the first option would be the 1.12. Now this option is already in the money, and what it means that it's going to cost us more if we're wrong than what we're going to make. So have a look at this. This is very important, this area right here, because even if you get confused between the bid and the offer and what does it mean and how much am I going to get out of it, this make it simple. You look at this area and you see, okay, if I choose this contract, then if it goes against me, I'm going to lose $66. If it goes for me, I'm going to make about $34. So I'm actually risking twice as much as what I'm going to make. This to me is not a good reward to risk. I mean, yes, there's a high probability that this market is going to expire in your favor, but what if something is going to happen? What if this market is now suddenly there's news coming out? I mean, maybe there's 16 hours left to go, or as you can see, 8 hours, and in this 8 hour it will test it again. It will be just a tiny bit above it at the time of expiry, and I would lose. What would it do to my risk reward ratio? I need to have, in this case, a lot more winning trades than losing trade, just so I can be on break even. So this is one option, not saying that it's not a good one, but it's something that we need to consider, is the fact that it's a much lower reward to risk. It's half, it's a 0.5 to a 1 reward to risk. The next one that we're looking at, the next option down, this is slightly out of the money, but what it does, it also reflects that move that we are anticipating in the market. When you look at your max loss versus your max profit, it's approximately at a 1-to-1. The market doesn't need to move a lot in order for you to get your 1-to-1. You can see that the market is just slightly above that level. So this option reflects a 1-to-1 reward to risk. Now, remember that what I'm anticipating a reaction to that level. So if I'm anticipating a reaction to that level, then I think that this market is going to continue much lower from where it sits right now. So I can look to choose a better option in that regard that would give me a higher reward to risk. It would also mean that this option is going to be cheaper, because if this option is cheaper, I'm going to get a better profit to my risk. So if you look at this option, for example, the 1.114, what you can see is that if I'm standing to lose 25, I'm looking to make about 75. It's a 3-to-1 reward to risk. The thing with this one being more aggressive is that the further you want the market to go, the less likely it is that it's going to do so. So that's why we call these options more aggressive one, because we're expecting a much bigger move in this market. Okay, so what else can I look to do? Well, I can take a 2-to-1 as an example. I can look at something maybe in between the 1160, that could be around the 2-to-1. Or what I can also look to do is split my risk. So I can take half of my position at about a 1-to-1. That's quite easy for the market to get. We're almost sitting right there. And I'm going to get a more aggressive one that's going to give me a 3-to-1. And combined together, I'm going to get a nice around the 1.75 reward to risk, or about a 2-to-1. So this is a really nice way of enjoying or thinking that I've predicted the market from this area. However, I don't want to put too much risk on the market, because what if it's not going to get there? What if it's going to be just shy of that level and then reverse on me? I don't want to lose everything. What it does is that it gives me a half at 1-to-1, and half might be losing, and I ended up with a break-even trade. And at the end of the day, I much prefer a break-even trade than a losing trade. So this is where we're sitting with that example right now. So this is the reaction to that level. This is the result in the market, and you can see that we also tested that level of 1.1140, crashed down through it, came up again. So it depends when the market has expired, because if the market expired somewhere over here, then my 1.14 expired worth this. But if I took half at 1-to-1 and half at 3-to-1, then at least I didn't end up with a break, with a losing trade. I ended up with a break-even trade. I could have obviously closed the position as well as it gone into profit. So it's all about the trade management as well. Let's take another example. Let's have a look at this example over here. So right now I'm looking at dollar yen, and really these trading strategy, or these sort of like scenarios that we're having, they're applicable to any market, any time frame, because it's utilizing technical ingredients, utilizing understanding the chart price action. So let's see what we've got over here. So right here, I'm looking at the 60-minute, the 4 hours, and the daily chart. Now, daily chart is in a very strong and roaring uptrend. Yes, we're a bit overextended from the moving averages. We had a pullback, but we don't know yet if this pullback is going to continue right here into the buy zone, which is the area between the 10 and the 20 moving averages, or we're going to continue higher from here. So in order to assess a bit more where market to, we're going to drill down the time frame. So looking down the 4 hours, let's see what we've got. Beautiful 4 hours trend, and what we can see is what we're pulling back into a level. We're pulling back. There's a level sitting right around here, and we're finding support on it. There's a touch here, and there's another touch here, and currently we're sitting on that level. So I want to see how the market is going to react to that level. So let's drill down the time frame. So the 4 hours is in a very lovely uptrend. When we're looking at this level over here, the 1 hour is in a downtrend. We're making lower highs and we were making lower lows. But right now we made an equal to a slightly higher low over here. So could that mean that we find nice support around this level and now we're going to bounce higher? Because remember, the overall trend is to the upside. And remember when we talked about the higher time frame pulling back, what it does to the lower time frame? Well, this is the same scenario. 4 hours is pulling back into the buy zone, and the 1 hour started to change direction. Doesn't mean that I'm going to take this 1 hour to the short side. So let's see what sort of reaction we've got here. So I've got you can see it now a little bit more clear. We can see the touches previously, that beautiful support level, this resistance level now turned into support level. What I want to talk about is a little bit on the candlesticks around. So I had a bullish candle sitting here. We bounced above it and then we fell. We're coming down again. We had a bullish candle and then we failed. I'm looking to see what this candle is about to do because we're looking to be reacting to that level. So I might wait to see how this candle closes, or I might take this off this level. It's all a decision that you can look to make if you are not sure about the reaction to that level. But mind you, because the 4 hours was in an uptrend, the daily is in an uptrend, and also we're talking binaries here, or spread, or anyway something that cannot stop you out if it penetrated through that level, then even if the market penetrate that level, reject it and continue higher within the next expiration time, I don't mind about that. So I might choose to take that off this level. So one of the things that I really like about the contract is that I can't get stopped out. So even if the market went below my entry, I can't get stopped out until this market has expired. So this is something that I really like, and I like the scenario. I like the push into that level, and I like to see a bounce of the 4 hours. So what sort of scenario, what sort of spreads and binaries can I look to trade off that one? Now remember, when I buy, I want to buy at the floor and I want to sell at the ceiling. Well, we were at 101.40. That was where the market is sitting, and you can see that I have one that is very close to where I am currently. So this is going to be the spread that I'll be choosing, and as the market is moving, I can look to make the profit up until the 102.9. So this is the you can see here the max profit and the max loss that you are going to have on this spread. So it represents a really nice win-loss ratio, reward to risk ratio. However, it doesn't mean that you're going to expire at your maximum profit. You're going to need the market to be on or above that level to get that maximum profit when we're talking about a spread. But when you're looking at a spread that's sitting really, to buy a spread that's sitting really close to the 4, it gives you the entire size of the move of the spread to get into profit. So a lot better than being at the middle or close to the edge of it. When we look at the binaries, let's see what we've got here. So we've got about 20 hours until expiration, which is good because we're looking really at a move from the 4 hours. So what we're after is about 5 candles in the 4-hour charts. And this is the sort of calculations that I do to know if this is a good opportunity to take on a daily, or maybe this time I should have gone for the weekly expiry on the binaries, because if this opportunity was of the 8 hours as an example, then what this translates to is 2.5 candles, and that might not be enough, which means I would choose the longer expiry being the weekly. But since I've got this opportunity mainly from the 4 hours, then 5 candles is enough for me to expect a move in this market. So let's take a look what we've got. So the market is sitting at the 101.4, and when you look at this level, you can see that we're going to get about 1-to-1 reward to risk. When you're looking at this level over here, this is the next expiry up, and what you can see is that we can get about a 2-to-1 out of this one. What sort of a move are we expecting from the market? I mean, this is only about 20 pips. This market moves quite a lot. So when we think about markets that tends to move quite nicely, then 20 pips is not a hard ask of a 20 hours type of scenario, 20 hours time frame. So I might look to do a 1-to-1 and then a 2-to-1. I might look to do a 1-to-1 and then a 3-to-1, because you can see in this one, the next one up, that gives me a really nice reward to risk as well. So let's see what happened with this market. So you can see this market, and this is the area where we were looking to enter. This is where we were. The market jumped higher, came down, tested the lower level, but you know what? It gave us enough time for the market to continue higher and expire in our favor. So this uptrend on the 4 hours continue, because this would still have expired in our favor. There was enough time for the market to move. We had 20 hours. Let's have a look at an example that is on a much shorter time frame. And on this market, on this very high liquid market, there's great opportunities on a lower time frame. When the market are very active during US Open and during Europe Opens as well, you get see a lot of volatility around those markets. So this is the 2 hours, and let's see what we've, the 2 minutes that we've got here, the 5 minutes and the 10 minutes. I want to start from a top-down approach. I want to go from the 10 minutes, and then I want to go down the time frame to look for those opportunities. So what we've got here on the 10 minutes, we do have a nice uptrend. We are pulling back into the buy zone. What you can also see, there's the previous high sitting right around here, and there's a pivot around this area. What we also have is we're pulling back into the 50%, so inside the Fibonacci buy zone. We're looking at the 5 minutes. You can see it's the same sort of trend coming up here, looking very nice in the buy zone as well. So we've got 2 time frames sitting here in the buy zone. When I look at the 2 minutes, as the 10 minutes is pulling back, what does the 2 minutes is doing? The 2 minutes is starting to downtrend. So we need to be aware of that. We don't only trade from one time frame. We trade from, we need to see the higher time frame to see the overall direction of this market. Now let's have a bit of a zoom in into the 2-minute chart. So what do we have here on this 2 minutes chart? So let's take a look. We've got this pivot right around here. It's also clustering with that 50%, and I've got this previous high sitting around this area too. Now yes, this market is in a downtrend obviously, because we have a high, low, lower high and a lower low, but as we've seen, what it does is as the higher time frame is pulling back, the lower time frame are changing direction, and we're okay with this. All right, so which sort of expiry, or which sort of option would I look to take for that expiry? So let's take a look again where we're sitting. So we're sitting around the 1.3540 or thereabout. I've got 2.5 hours until expiry. Now, what I like to do to sort of think how far or how much this market can travel within that period of time, let's just come back to the 10-minute chart and let's take a look. So we had a move from about 1.3520 to around 1.3550, so approximately 30 pips or there's about. We had that move. Let's see how many candles it took us to make that move. 1, 2, 3, 4, 5, approximately 5 to 6, so about an hour to make 30 pips. Let's see it on this area. So we moved from, this is around 1.3510 all the way up 35. So we're looking around 25 pips, and it took us around 1, 2, 3, 4, 5, 6, so about an hour again. So approximately during that trading day, we're moving between 20 to 30 pips within an hour. Okay, but then we have to account for that pullback as well. So you can see the pullbacks are a lot faster, and it's about approximately 0.5% of the way, half of that way. So when I look at this scenario, and I know I've got 2.5 hours until expiration, I can actually get a nice 2-to-1 out of that one, because if we're sitting at this area 35, 38, this is where the market this. This is only 2 pips above. So that will give me an approximately 1 to 1. And then if I can look to get this higher, this is where I'm looking to take. So I gotta make that decision, which one will be the correct one to take, because I don't have a lot of time until expiry. Do I want to be conservative and just go with a 1 to 1, or do I want to be very aggressive? I think that this market has a lot of move in it, and I think that I can get it in the right amount of time. So what sort of decision would you do? Would you go the more conservative, or would you go the more aggressive? Because really this is the kind of decisions that we need to make. And by the way, if the market is moving really, really fast, you can choose to be aggressive and close that position as well. So you can put a limit order to exit from that position. So what would you do? What do you think is the way that you would go? And there is no really right or wrong answer. It's just what sort of a trader you are, really. So let me know. I'll give you a couple of seconds to have a think about that. Maybe I'll bring back the charts, and what do you think? Because really what we're expecting the market for the next price of the option to take this previous high within the next 2.5 hours and not pull back too far. So what do you think? It's an interesting question, I agree. Okay, so let's assess this together, because I get that it's a bit hard to decide. We can also do, okay, we're going 50-50 here. That's interesting. So what you get from, all right, it's a good question. So from this one, you get about a 1 to 1. From this one, you get about 20 to 1. It's a really interesting scenario right around here. So it's a very nice reward to risk, but it is a risk. So yes, we are going to go long. The question is, which option would you prefer? The 1.3540, which give us about a 1 to 1, or the 1.3560, which give us about 20 to 1. And we've calculated approximately how much this market moves within an hour, and then it pulls back. So obviously we don't have to hold it until it pulls back, but what do you think can happen? Okay. Well, yes. So I got a question. If I look at buying and selling at the same level, so when I enter into a trade, I will enter into all of them together, because my calculation is that if I'm thinking about a 1 to 1, then it's a 1 to 1 at this point. When the market is moved, the valuation is going to change. So if I'm not entering approximately at the same time, then what I could perceive as a 1 to 1 and a 3 to 1 could actually turn into, quite a good a 1 to 1, because I already entered into it. And then my 3 to 1 turned into a 2 to 1 because the market was moving in my favor. And then the valuation of the option keep on changing. And then closer you are to the strike price, the more you have to pay for that option. So yeah, I'm doing the entries for both of those trades. If I was looking to scale out, I will be doing both of them at the same time. A question: how is it a 20 to 1? Is that risk or leverage or neither? So when you when you use the Nadex contract, when you buy, you've got the bid and the offer. This is the sell and this is the buy. So we're looking to go long, so we are going to buy. So this option is going to cost you $4.50. So if this expire worthless, then what you're going to lose is that $4.50. So it's not leverage in the regular sort of way when you put a little bit and then your broker put the rest and that's your leverage. This is different. When you enter into a position, you're taking out the amount that it costs you to buy into that position or to enter into that position. Okay, so in this case it would be 4.5. If this expires in your favor, then you will get paid out 100. So for each one contract. So one contract costs you 4.5, and you got 100 in return, and that's approximately a 20 to 1. So that's how you do it, and this will be a 1-to-1 call. It costs you $45 to enter into it. So there is leverage, obviously, but that leverage is not the same as, let's call as a margin, right? It means that this amount is taken out of your account the moment you enter into the trade. Okay, so you can never lose more than what's been taken once you're entered into that trade. Okay, so that's how you do the calculation of the reward to risk. And when you enter, one of the things that you can choose to do is you don't have to be just conservative or just aggressive. What you can do is you can split the decision between them. So you can say 50% of my position I'm putting on this one and 50% on this one. So say, for example, my risk is $100 per trade. So I can buy one contract of this one and I risk $50, and I take the second $50 and I can buy 10 contracts of this one. So if the market indeed rally in my way, then I made a really nice reward to risk out of this one. But if the market did not get to that 1.3560 and fell shy from it, at least I didn't lose too much, because this one gave me a 1-to-1 and this one expired worthless, and I am in a break-even trade. Okay, so this is the sort of thing that you can kind of mitigate that risk. It's a really, really amazing reward to risk, but you're expecting a huge move relatively within a short period of time. If we come back into the 10 minutes chart, and as we calculated the size of the move, it's not unheard of. It can happen, but you just need to know that there's an increased risk, just because as we're running out of time on this option. So this is the result. This is where we entered. And this is when the market has finished at expiry, and you can see it finished just shy of that 1.3560. So one of the things that you can do is, as you come in, you see this sort of, when you come in up close to expiry and you try to sell into it, it wouldn't have a lot of value because it's out of the money and it still needs to move about 5 to 10 points in order to get to be in the money. But when you see this sort of price action, that the market starts to go sideways and it still have some time value in it, you can look to exit, and you will have a bit of profit at that one because you're closer into that level. So there's trade management that you can do around that while reading the price action into it. Every decision that you make obviously affect the profitability of your account. So being very, very aggressive could be that you won't have a lot of winning trades, but when you do, they give you a great reward to risk. Being very, very conservative means that you don't get a very good reward to risk, but you get more winning trades. So you got to find a nice place in the middle, a sort of like a good balance between reward to risk and win-loss ratio. So at the end of the day, your account will be at the black. Question: do spread move faster towards expiration as binaries? So with the spread, because it's a variable payment, with option, you've got with binary, it's an all or nothing, right? So as you come closer to expiry and you're still out of the money, you will move really, really fast towards the zero, right? Because you're out of the money and there's not enough time for you to get in the money, and that's what happened. When you talk about spread, say you bought at the floor and the market is sitting somewhere in the middle, then it doesn't make much difference into the amount that you're going to make, because you're still going to make the difference between when the market sits and that where you bought, right? So there's still that length of size. So that's why it's a variable payment. It's not an all or nothing. If you're out of the money, then you're out of the money and there is no payment. If you're in the money, then the payment is of the distance of where the market is in the money and the entry that you got. Does that make sense? They're very different in that respect. All right, so how can you take your trading further with Nadex? And yeah, feel free to type us questions if you've got about these topics as well. All right, a few of Nadex benefits. So it is an entirely new way to trade the world of financial markets, and you've got some really unique benefits. I think the best benefits, in my opinion, the most amazing thing is you've got control risk. I can't tell you how important risk is as a trader. You know, one of the examples that I like to give, and I can't stress this enough, how amazing this is that once I was on a trade on dollar yen and it was going in my favor. It was close to expiry. Everything was looking great. And then there was an intervention from the Bank of Japan, and suddenly a trade that was moving nice and slowly in my favor completely reversed against me, and within splits of seconds it turned from a nice winning trade into way losing trade. So, you know, over 100 points of a move. Now, it doesn't matter with the binaries if I lost over 1 or 2 points or I lost over 100 points. I still get the same losing amount, so my risk stays the same. But if I was on that market, if I was in the traditional way, if I was in the market, I would have been taken out for a lot more than what I planned to, a lot more than my 1% risk, because there was no exit. The market just basically slammed down with that. It was unbelievable. So it was just so strong of a move. There was no exit at that time. So in that respect, it protected my risk. Yeah, I ended up with a losing trade, that's for sure, but at least it was within my prediction of my 1%. It didn't create a havoc on my trading account. Okay, so how is that protection if the market spikes? If the market spikes and then reject that spike, you're not taking out. The problem with spikes, if you have a traditional stop loss, is, say for example, you're going long and the market overall is moving higher, but suddenly there came one piece of news, shot the market down. It would have taken you on a stop loss, and then the market think, oh, you know what, actually this is not so bad, and then continue in the overall up momentum. These things happen, and that's how we see spikes in the market. You would have been taken out on a traditional sense, but if you are, say, in a binary, then all that it would do is that when the market spiked down, you would be in the red, but then the market continue higher, and if there's still time until expiry, so so the market can still expire in your favor. It still allows you for that time. You don't get stopped out. The stop loss is sort of like built in within the market, because I would never ever enter into the market without having any protection for my risk, for my account, right? Because you can end up losing a lot more than what you planned. So with Nadex, you actually don't need to place a stop loss, because it's inherent inside the meaning of the binaries and the spread. If it expires against you, all that you lose is your risk. Okay. So the next question asks, so what you pay is your bid. Well, I wouldn't call it bid, but yeah, what you pay is is how much it costs you to enter into the market, right? Because bid and ask refers to the spread. So if you bought into a market, you bought at the ask. You didn't buy at the bid or at the offer. It's another name for it. So yeah, so what you end up paying if it went against you is your risk, is how much it costs you to enter into that position. That's cool. That's happened to me, red folder, I think. Yeah, so it is really fantastic. Controlling the risk is one of the most important things out there. Just confirming, the open of the termination time is the win-loss point, right? What do you mean the open of the termination time? I don't quite understand. If you mean what is the expiry, so where the market sits at the point of time that the option is expires, that's the level. So if you sit in the money, then you made your reward. If you sit out of the money, then you lose your risk. Is that what you're asking? You need to look at where the market sits at the time of expiration. So what happens if it keeps going lower and doesn't bottom down? So if you thought the market is going higher, but actually the market starts to go lower and kept on going lower, then you're in a losing trade. But all that you lose, regardless of how much low the market is, all that you lose is your risk. So your risk is always capped. Okay. All right, so back to the slide, and again, if you've got more questions, happy to answer them to make things a bit more clearer. There's also opportunities, as I mentioned, in flat markets, and as I said, you'll see this now on euro dollar, because it is stuck in a range, but it's a nice range. It's not a small range. It's not a range of 20 or 30 points. It's a nice big range. So when the market come and test the 1.10, I can look for a reaction of that level. If it rejects it, then I look for a pullback into the 1.08. Obviously, all of that to do where the market sits, what sort of binary I can take at that point in time, how much forward expiration, and so forth. There's a wide range of market to trade as well. And you can find a short-term, hourly expiration to weekly contracts. So it all depends really on the time frame that I'm looking to take the trade, is which expiration and I'm going to take. So you also have fees that are capped. There's a 90 cents per contract, and it's capped at $9 per order, and it's fully regulated exchange. This is very important in my opinion, because I don't want to be putting my money in my account and then things disappear. So it's important to have regulation. There's oversight over the dealing, and it is regulated by the CFTC. And you also got the training program that we offer, the Trade with Precision offer with Nadex. So sorry, not saying that Nadex offer with Trade with Precision. And we run that webinar, so sorry about the confusion, and it's all complimentary for Nadex client. So what we do, we teach the way we look at the market, and we teach the way we look for opportunities in the market, the technical ingredients that we are after. This is how we trade, right? And this is run over 4.5 hours of education program, 1.5 hours each week. And what we do, we cover the technical ingredients, so we add more of the stuff that we looked in today, and we'll spend a little bit more time on it. I had to rush in because we didn't have a lot of time today, and then we'll take all of that and we'll build it into 2 complete trading strategies. Now this is run live, so you get the ability to ask as many questions as you want, because you know what, things are not always clear, so it's important to be able to ask the questions while you're watching the explanation and all that. And it's valued at $900 and completely free for Nadex clients. First part, we're going to look at technical trading ingredients. Second part, precision trading strategies. And third part, we're going to look at spread and binaries in action. Let me tell you when we're running that. I can see the question coming in. So we're starting. Okay, so the first session is going to be on the 11th of February at the same time that this one was for you. So depending where you are in the US, it starts at the same time, and it's going to be for an hour and a half, and you are most welcome to come and attend, and as I said, ask as many questions as you need. So this is provided to you by Nadex. Let me pick up a couple of questions. Thank you, very helpful webinar, especially for someone new. Thank you, that was great. That was awesome, thanks. Fantastic, I'm really happy that you find that useful. Is that at the close, say 11:59, or at the open? It's at the time of expiry, so you will find it. I see what you're asking. If you want to know exactly how that's calculated, there's a method behind that. So the closing price is not exactly on that second. There's they're taking it from a couple of providers, and then there is removing the higher 5, removing the lower 5, and then an average of in between. There's something around that, so it's very well calculated, so there won't be any issues. If you want to understand more around how exactly the expiration amount is calculated, then give Nadex a call. They'll explain to you in detail how it works. Do you have a mentoring program? You can address that question to Nadex as well, if they have an additional mentoring program, but what we do have is that advanced course. We also have a couple of other webinars as well that we're doing that are complementary by Nadex. So understanding a bit more about commodity market, oil, that's very interesting lately, and index market as well, lots of opportunities there, and also understanding options and binaries too. Okay, excellent webinar. You are a great teacher. Thank you so much. Thank you very much. Appreciate it. That's fantastic. Thank you, everybody. There's going to be a survey at the end of this one, so let us know if there's anything else that we can do for you or any other question we can answer you. And yeah, very much looking forward to see you on the advanced course. I left a couple of minutes for questions. There's usually a lot at the end, so let me know if there's anything I can help you with. Thank you. Great presentation as usual. Thanks. Thank you so much. That's fantastic, guys. I'm glad you enjoyed it. It is a fantastic market to trade. This one with dollar yen, one of my favorite. And even when it's stuck in a range, when you go down the lower time frame, that's the beauty about these markets that are so liquid that you can trade it on 2-minute charts, on 5 minutes, on 10 minutes, and it will give you great opportunities. So even if the 4 hours doesn't provide us with much opportunities, the lower time frame will, and that makes it so very attractive to traders, and really nice moves that happen each direction every day. Yes, very informative. Thanks. All right, fantastic. So if there's no more questions, I'll wrap this up. Thank you, everybody, and I'll look forward to see you on the advanced course. So it is 2 weeks from today, so I'll speak to you then. Bye for now.